Great. All right. Take it away.
Welcome to Live Money Matters. My name is Bill Erickson, and this is the first live seminar I've done in over 2 years. That includes Small Business BC, seminars for the library, and I have to tell you, looking at my own face on Zoom really is not the way I would go through things. Now, you should have, did you send out the big notes to everybody?
Just at this moment.
Just at this moment. Plus, we're going to send some notes that are the copies of the PowerPoint slides for this evening. What happened was, as we morphed the seminar down to 3 sessions, we left the notes for when it was 6 sessions. So you've got information in your notes that I will not be covering due to lack of time. I should tell you who I am. My name is Bill Erickson, and apparently it's tradition here in Whistler to tell people how long you've lived here. I don't understand why, but I have lived here 10.5 years. I figure in about 15 more, I will be considered a local. My background is actually in business training and business finance, but I got so many questions from people about personal finance that several years ago, do you even remember when we did the first one? Well, it was like you hadn't even taken this position yet.
No, 2015.
Yeah, I think it was about 2015 when we started doing this, and it's been fairly popular. People apparently are dying to come out and see me live, clearly, and it's been fairly successful. I am not a financial advisor. I cannot sell you anything. I have no skin in the game whatsoever, so I will tell you the truth. Now, for those of you who haven't been with us for previous sessions, remember my premise, the way I work on these is money does 2 things. It comes in and it goes out. Any questions? Good, you know everything you need to know about finance. The way I also break it down is where does money come from and where does money go to? And money comes from 2 places. It comes from earning or entitlements. I just don't put the entitlements there because it makes the graph look lousy. So earning would be the money that you get from various different sources, and that can include employment income, self-employment income, and some of the things we're going to speak about tonight, which is investment income. On the other hand, the other way you can get money is you go out and you borrow it. And that's why in the last session we spent some time on borrowing, controlling debt, different forms of debt, and credit scores, and the importance of managing and understanding your credit score. Tonight, what we're going to talk about is the money that comes in, that you either spend it, we talked about spending last time too, or you keep it. Well, what do you do with that money you keep? But you want to have more money to keep, and unfortunately, when you earn money up in the earn box, Her Majesty's government likes to take, or both governments like to take a little piece of that. And it's really critical to understand basic taxes before engaging in any kind of savings and investment program. And it's absolutely critical. So what I'm going to do is I'm going to talk for about an hour on taxes and the way the tax system works. Now, this is not an advanced tax session. If you're looking at how to evade income tax and transfer pricing and bank account in the Grand Caymans, I'm probably not the right person to whom you should be speaking, and you're probably at the wrong session. But I do have a fairly good understanding of taxes and basic taxes. Now, how does the government take money? And I'm going to talk about types of taxes. In the big notes, I've got examples of all of these, but I just want to explain that there's various different forms of taxation, including good old payroll taxes. So when you work for somebody, you pay a contribution to the Canada pension system. You pay, unless you're self-employed, employment insurance. But your employer also pays those things. In addition to that, your employer is paying your workers' comp. It's now called WorkSafe. I remember back when it was workman's compensation, back in the olden days. But they pay contributions to WorkSafe, and in British Columbia, there is an employer health tax, which replaced the medical services tax. And that's the tax paid by employers. Those are forms of payroll taxes. Consumption taxes are taxes that you pay when you actually purchase something. And that would include GST, PST, excise taxes at the gas station, carbon taxes, anything that kicks in when you consume it. Tariffs are one. And in fact, for many years, governments made most of their money through tariffs and consumption taxes. There's also asset and wealth taxes, and the primary example of that, of course, is property taxes. And I do believe that one of the versions actually went into how they do the calculations for property taxes. And then there's this really weird and wonderful thing that Margaret Thatcher experimented with about 40 years ago, and it kind of got her kicked out of being Prime Minister of the United Kingdom, called poll taxes. And that's where everybody pays the same. And the one example of that I can think of here in Whistler is our sewage taxes on our property taxes. Every household pays the same amount, regardless of how large it is, what it's worth, it's all the same. So it's like a user fee type of taxation. But the bulk of taxation in Canada and in the province of British Columbia is income tax. And understanding income tax is very difficult. And there are high-end tax strategies that I frankly barely can understand the language behind it. But for most people, understanding the basics of income tax isn't really that difficult. And in fact, they've made it very simple for you to do your income tax, because now they have a thing called autofill, and it will automatically fill in your tax form. But please double check it, because it makes a lot of mistakes, and you're still responsible for mistakes. Especially if you have any capital gains, don't trust it. It doesn't work. I know that because I once looked at my tax return and I owed them $4,000, and I knew I didn't know the $4,000, so I knew there was a mistake somewhere. We pay income tax on various things, and these are just some simple examples. Earned income, so if you work for an employer, you'll pay income tax on that. If you've got some money in the bank and it pays interest, even though it's not very much, it will be getting higher, by the way. Interest rates are going to go up. You'll make interest income. If you own a property, or not your principal residence, if you own property, or if you own a stock, or if you own Bitcoin, I think I'm right on Bitcoin, don't quote me, and you buy some and you sell some, that's called a capital gain, and you pay tax on capital gains. And if you own some stocks that pay you a dividend, then you will pay tax on the dividends. The reason I break these out is we're going to learn later on, not everything is taxed in exactly the same manner. And knowing how something is taxed can have an influence on the way you choose to keep and invest and trade money. Here's some things we don't pay income tax on yet. We don't pay income tax on capital gains if you sell your principal residence. Although there's now a movement to ask for a tax on all sold properties over $1 million in Canada, which would really make people in British Columbia quite frustrated compared to people in most of the rest of Canada. I don't think you're going to see that. That's a third rail in Canadian politics. You don't pay tax on lottery winnings in Canada. What? You do in the United States. You do not pay income tax on lottery winnings in Canada. So if you're at the casino and you're playing the slot, but by the way, by the same token, you can't deduct your losses in gambling in any way, shape, or form. Life insurance payouts, by and large, are not subject to income tax. And so a lot of people will use life insurance as an integral part of estate planning. And by the way, estate planning and insurance is by far my weakest area in the world of finance. It's a specialty field. And quite frankly, I haven't got the time or the inclination to go out and study it. And inheritance. In Canada, we do not have an inheritance tax, but here's what happens in Canada. Different provinces have a probate fee, so the estate is taxed, not the inheritance. And when you die, or when a person dies, not you, I want you personally to die, whether you're a Zoom person or an in-person person, if that makes sense. The estate would pay tax. So for example, if you died and you had some stocks and those stocks had gone up, those capital gains would be paid by the estate before that money was distributed to the various people to whom you are leaving money, or the deceased is leaving money. And so there's a death tax return, and if it's still earning money, there can actually be up to 3 tax returns that's in a trust. It's a little complex. I've never done one. I'd probably just have an accountant do it myself. But it's paid at that time. Interestingly enough, in the United States, they don't have that. They have inheritance taxes, but when somebody dies in the US and they leave their dependents money, that money starts over again at the new tax rate. They don't pay capital gains on. That's how the rich continue to stay richer. If they just implement the Canadian system, that would take care of that whole problem. That's the way we do it. Now, that doesn't, like, if there's rules for spouses that are somewhat different or people with joint accounts. So again, just so you know what you don't have to pay tax on. Now, Canadian taxes changed fundamentally about, let me say about 20 years ago. No, it was longer than that. Oh my gosh, I'm getting 1994, the Wilson budget of 94, if I'm not mistaken. And what we used to do in Canada, as they do in many other countries in the world, is you have your income and then you have deductions. And then what's left after the deductions is what you pay tax on. But that's not what we do in Canada anymore. We do have income and tax deductions, but now a lot of things are taken care of, not through deductions, but through tax credits, which come up from the bottom. So some things are deductible, but some things are what we call tax creditable. And there's a big difference, because when something was a tax deduction and you were in a high income bracket, that $1,000 of tax deduction means a lot more to you than somebody who's in the lowest tax bracket and therefore doesn't get the same advantage. With the tax credit system, everybody, regardless of their income, gets the same net advantage kind of coming up from the bottom. And I do have an example of that I will show you. In fact, that's one of the reasons I sent a copy of the slides. I decided to do this at the last minute. So in your notes, and you should have a supplemental document, I have copied the latest tax tables for this tax year and for next tax year for the province of British Columbia. This is the combined federal and provincial tax rates. And what you'll notice, remember I said earlier, there's different forms of earning. Well, what you'll notice, and I love the way they call it other income. Basically, that's almost everything. So that would include earned income. That would include interest income. That would include self-employment income. That's all in this group called other income. And those are the tax rates that you pay on that. You'll notice the dividends, both qualifying and non-qualifying. I'll explain what that is in just a second. It probably won't mean much to anybody, but if anybody out there is self-employed, it's a big deal. If you're self-employed and you have your own corporation, this is a big deal. So your dividends, they do this really funny calculation. They gross it up and then they credit it back to you. And what you'll notice is if you're a fairly low income earner, if your income is under 50, your taxable income is under $50,000, you pay negative income tax on dividend income. However, there is a catch. There's always a catch, isn't there? If you were in a position, and I ran this just to test to see whether I was correct or not. If you were in a position where you, in the province of British Columbia, you had $50,197 in dividend income and no other income whatsoever, you'll notice that it says your marginal tax rate is still negative. They don't give you the money. There's two kinds of tax credits. Tax credits that can take you to zero, and tax credits that are called refundable tax credits that if you're below zero, they do write you a check. Your child tax credits would be examples of those. So your child tax credit takes you to zero, they will give you money. But if your dividend tax credit takes you to zero, they keep it. It will take you to zero, but it won't take you into a negative tax situation where the government cuts you a check and says, we love you very much. Have a nice day. Which is the technical. Oh, by the way, CERB and any other of the supports from the federal government during COVID are in the other income bracket. It is as if you have earned it, except it was not subject to Canada pension or employment insurance. So you didn't get employment insurance credits for that. So these are your tax credit. A lot of people say, well, gee, Bill, if you're making over a certain amount of money, does that mean 53.5% of all of your income goes to Her Majesty's government? No. What it means is you pay this much on this amount, and then once you pass that, you pay this much on the next dollar, and then it goes up in steps. And we call that a progressive income tax system. And many of you may remember several years ago, people were promoting what they call flat income tax. And they actually put that into play in Alberta. Alberta's a flat 15%. Everybody pays the same amount. But most economists and most governments have increasing tax brackets on the next dollar you make. So don't worry that you know, if you made $50,000, you just jumped into a new tax bracket and you're going to pay 28.2% on everything. That's not the way it works. You'd only pay 28% on the next dollar. So that's the way a progressive tax system works. So the way we do things is we take our income from all of those taxable sources, not the non-taxable ones. Don't worry about your lottery winnings or your casino. I think you may need to worry about your lottery and casino habits, but that's a different seminar altogether. That's our addictions workshop, which is a completely different night. So what we do is we take all of the income and we put that in, and that comes from your various T slips that you get from the government. And most of you have heard of your T4 slip. And if you were on Canada pension, what's it called? T4 CPP or C4CP or something like that. You can get a T4A if you have pension income. But you'll get a T4 for pension income, earned income. I don't know what the form for the Canada, no, not CW, CERB. I always got the two confused. But you'll get something for that. It's a T4E for your employment insurance. I believe
they were just attached to the idea of a T4.
Yeah.
Like you could have a T1 or T7.
There is a there's a T1. Your actual tax return that you fill in, that's called a T1 or a TD1. A T2 is for a corporation, and a T3 form is for trusts. And then you've got T3s that you get and T5s. See, doesn't this get fun? And never, don't get me into T20 to 50008s. But you will receive, if you have investment income, you get a different form of T slip. But when it has a T on it, it means you're going to pay tax. T is for tax. I don't know if T is really for tax, but it could be. And the Canada Revenue Agency, as your employer or your investment people are sending these out, and there are different deadlines. So you should have your T4s by now. The T4 deadline was the end of April. And then the end of March is when the investment deadline is. And then there's one for trusts that's in middle April, like it's really close to when your taxes are due. And it's always the last one that comes in. And it's a fairly obscure one. But that's what you will use, and then you will calculate your income. Actually, you won't do it. You'll put it into the computer, let the computer do it. That's what I do. I haven't done a manual tax return for years. I remember having to do a whole bunch. There was this guy that hadn't filed in 10 years. We didn't have software for it. Manually did taxes. But I can remember manually filling the form in and getting the little tax tables and microfiche and looking down and writing it in and double checking my math before sending it to Ottawa or no, Summerside PEI, I think it was.
My father-in-law still does that.
I know people that do. I do know people that actually manually calculate their taxes. I don't know why, because you can get free online software now. But I've been doing mine by computer. Actually, I even do my own report as well. Then what you do is you've got this number and it's called your taxable income. And then you calculate how much tax you would pay if you paid tax on your taxable income. But you don't pay tax on your taxable income. Because everybody gets a universal tax credit for being alive. It's called the Being Alive Tax Credit. It's actually called the personal deduction. And if you are fortunate to live long enough, at 65, you get an extra little bit. And that's, again, another tax credit. And so there are various things for which and on which you get tax credits. And as I said earlier, they can be deductible, or I'm sorry, they can be refundable tax credits. That's your child tax credits. You can get money back for that. Or non-refundable tax credits, which can bring your income tax liability to zero, but they just go, oh, I'm sorry, we should have paid you, but we're not going to. Have a nice day. That's just the way it works. So then what we do is they calculate the tax, you take the tax credits and you apply the lowest tax rate to the tax credit. And it looks something like this. So, sorry. So here's all the sources. I jumped ahead of myself, I apologize. There's your income, your earned income, self-employment income. By the way, self-employment income, this is what caused all the problems last year with the Canada wage benefit, CEWS. Yeah, not SERP, CEWS. Yes, CEWS. Because they just said you had to have $5,000 in income. What they failed to take into account is there are two different lines on a tax return for self-employment income that say income. One is the revenue that you generated, and in tax language, they use income. And that's the gross income. And then you take off your expenses for your business, and that's the income on which you pay income tax. That's what they intended. Their thinking was if you didn't make a $5,000 profit, it was a hobby, not a business. But they weren't clear on it. And so what they did was they ended up letting people keep the money even if they only had $5,000 in revenue. Because there were two lines that said the same thing. All your pensions are deductible, but you do get a $2,000 credit for eligible pension income. So it's like you get the first $2,000 of pension income is kind of like it's tax-free. However, it's from the bottom up, not from the top down. So it will save you at the lowest possible marginal tax rate. And we don't have the, if you've got the sheet in front of you, it is the line that says, I'm probably really loud for these people now. So that would be the 20.06% number, the very first number. So your tax credits are as if you're saving money, but at the lowest tax rate. And that's why a lot of people think a tax credit system is a little bit more fair. And that's why they moved to a tax credit system in the 90s. It just makes things a lot more complex because when you tell people about deductions, they get it. When you tell people, oh, you're going to get this and they're going to take this and they're going to gross that down by this, they just look at you like, you know, all I can see are dancing cows. But I think it's important to have a fairly good understanding of at least in principle how the system works. Then you'll get deductions. There are some things that we still get to deduct. Your RSP contributions, for example, are deductible from your income. They reduce the amount of income and you'll receive that money as if you didn't earn it. So for our friend that was making 50,000 and change, if they were to, you know, make 51,000 and put $1,000 into an RSP, it would drop them out and they would save money at the top tax rate, not the bottom tax rate, like a tax credit. So deductions are quite good, and the more money you make, the more tax value there is to a tax deduction. Some of the other things that we deduct, union and professional dues are tax deductible. And then there's this little secret. It's called a carrying child tax. Child expenses are deductible, but I believe it is in the hand of the lower tax payer if there's a couple. So it's the lowest income earner that can get the deduction. So you can't just move all the deduction to the highest person. And that would be an example of a deduction. Union dues and professional fees are tax deductible as well, as are these wonderful things called carrying charges. And in our final session, I am going to show you some tricks on how you can lever investments and take tax advantage of the fact that you get a full deduction on interest income or on interest expense that is used to make investments. But you can use that to make investments that actually pay a lower tax rate. So if you borrow money and buy dividend-bearing investments, you get a double bonus. You get the money that you get from the investment, plus you deduct the carrying charge, but you get a tax credit or pay half the income tax if it's a capital gain. And so there are some techniques that you can use. Interestingly enough, even though it makes perfect sense, I don't lever my investments, because and I'm gonna show you what happens when the lever swings the other way. But that's a tax advantage a lot of people are unaware of, and they don't know how to take advantage of it. Some things that are tax credibles is your personal and dependent. So if you've got dependents, whether it's a dependent spouse, if you've got children, you will get an additional tax credit for that. As I mentioned earlier, when you get to a certain age, they give you a little bit of bonus money. I do not understand why, but I have a hunch that it's because old people vote. That's my theory, and I'm sticking to it. Actually, it goes back to the days where elderly poverty was a huge deal in the 1960s, and in today's world, as a demographic group, it's actually one of the smallest demographic groups of poverty in Canada. It's only about 3.3% of seniors are in poverty. You get a disability tax credit if you have a specific disabilities. EI and CPP are interesting. EI, you get a tax credit. CPP is partly a tax credit, but now part of it is deductible. And it had to do with them increasing the CPP. CPP is going up at a fairly rapid rate. It's now gone up, and I believe for this year, it's 5.25% of any income that you earn over $3,800. And I really noticed it this year because I stopped paying it. And all of a sudden I got a real big raise. Tuition and student allowances. And that's kind of a neat one, because if the student doesn't need the tax credit, that tax credit can be transferred to a parent or a grandparent. Well, I didn't think you had grandkids. Yeah. But if you want now, and for a lot of students that don't have any income, well, they don't need the tax credit, and it's a non-refundable tax credit. So the government just doesn't give you the extra money, but it's a transfer. It's one of the few tax credits that's transferable. And so a lot of times, what they'll do, and you get a certain amount for your tuition, and you get a certain allowance, and I don't know what it is. I remember though, when it was $200 per month for full-time students. And full-time students, and I'm going to use the semester version of this. UBC uses a different system, but effectively it was 9 credit hours per semester, which is effectively 3 courses. If you were taking 3 courses, you're considered a full-time student, and you get that. Oh, the lie detector went off. I must be lying on CAD. So that is an interesting tax credit in that it is deductible, or sorry, it is transferable, and that tax credit can be used. But again, the beauty of, well, whether it's good or bad, depends if you're rich or not, everybody gets the same advantage. It's not like somebody getting a tax deduction, whereas if you're a $100,000 income earner, you're dropping your income tax liability by substantially more than if somebody is, say, at the $40,000 level, where you're still at the 20.05. I don't know why it's 20.05. It's 15% plus 5.05% provincial sale income tax. I don't know. They could have rounded it down, but no, they didn't. It probably had to do with an inflation calculation. So here's I tried to come up with something that was simple enough that we could just sort of follow through with it. So you just take a look at that. So somebody made $40,000 a year in income, and they had a $2,000 RRSP contribution, which they by saying 40,000 here to make an RRSP contribution, but that's neither here nor there. So it drops their taxable income to $38,000. There's actually an income, another line, and a taxable income line, and I still don't understand what that middle line means. So now what we do is we take the 38,000, because it's below the top level, we would just multiply that by the 15% provincial rate and the 5.05% 15% federal rate, 5.05%. That's your tax before credit. That's not how much you pay. Nobody pays that amount. because everybody gets a personal tax credit of $14,000. Now, what does that mean in English? What is the net effect of that? That means if you make $14,000, it would cancel everything out. So you have $14,000 and you pay no income tax whatsoever. You really don't start paying income tax until $14,000. Used to be deduction, now it isn't. Now it's tax credit. Provincially, you get to start paying $11,302. But keep in mind, the provincial tax rates in British Columbia, until you get over the 100,000 marks, are substantially lower than most other provinces. And it used to be, because when they brought the carbon tax in, it was actually an offset against your income tax. Boards pretty quickly. So we'll take the 14,000, and then the EI and CPP also generate tax credits. And so they get added into this. And then for the federal government, there's a thing called the employment tax credit. So if all of my income was non-employment related, like I didn't get a T4 at all, I wouldn't get that. We're assuming that this taxpayer has earned their $40,000 in employment income to qualify for the $1,287. And again, these numbers used to be nice and round, and then they indexed them with inflation, and then they became really goofy. So you add it all up, you've got $18,000 federally, $13,000. Now that doesn't mean you get to subtract that off of your income tax. No. We then multiply that by 15% for Canada. That's the lowest tax rate in Canada, and 5.05% in British Columbia. And that subtotal is what we subtract from the tax before credit. And in this case, the taxpayer would pay $4,155. If said taxpayer paid $4,500, they would get a refund of $345. It didn't quite come out in the news. Now, in real life, only a single person with a job and nothing else would ever have anything close to this simple. Most people would have some other things. You might have some medical, upon which you get a tax credit, that type of thing. But in real life, that I just wanted to show you an example of a tax credit and a tax deduction in the same thing. But that's sort of the way it works. Actually, it's not even sort of the way it works. It is the way it works. Now, I know many people in here and in it's really interesting. It's almost like divisive. It's like real people and Zoom people. It sounds like there's some kind of a wild science fiction show.
You're all real to me.
Yeah, I know. You know, where are they? Where's everybody else? They're the Zoom people. But we love it. Yeah, it's such a treat for me to see faces and be able to stand up and not sit in my kitchen table doing a workshop. I gotta tell you, the jokes didn't get any better, but at least in my new way.
They feel fresh after 2 years.
Yeah, really. Yeah, well, it may not be the fact that it's 2 years, maybe your memory is slipping. So supposing you want to look at some tax shelter ideas. Where's here? Oh my goodness, I do not have a dearth of pens.
Are we stopping for questions?
Yeah, you can ask me a question
I
anytime.
think Louise also.
I was going to cover that, but I'll answer questions now if you want. If you have a question on tax-based tax system.
Well, yeah, here's a real basic one. When are they due?
You must, if you're not self-employed, you must file by the end of April. If you are self-employed, you can file as late as I believe it's the middle of June, 15th of June. However, if you owe the government money, or if you have a penalty, interest is charged from April 30th. If anybody is dual citizen, Canada and the United States, and there are many people in Whistler, surprisingly, who are, the deadline for the United States for the IRS is the 15th of April. And unlike most countries in the world, the United States requires non-resident citizens to file with the IRS. It's interesting.
Is prize money taxable?
That is an interesting question, and the answer is it depends. And it depends on whether or not, because prize money, depending on how you slice it, if it's in a random game, it's like a lottery. But let's say you entered the Whistler Poetry Society contest,
Exactly.
okay? It would not be taxable unless you were a professional poet. And then the Canada Revenue Agency says, this is what you do for a living, and therefore we are going to tax. It's technically considered to be more like an honorarium than like a prize, which would be typically used for a prize from something like a lottery or whatever like that. And it's always a bit of a gray area. So like, what if you're a novelist and you win the extraordinarily expensive I think it's $200. I think there's 2 categories this year there. I don't know.
For the poet's pause.
I think there are 2 categories, two different subject areas. Yeah, every year my friends tell me I should enter it, but I only write funny poetry. They don't ever seem to like that kind of stuff.
You won't know until you try.
I'm judging this year, so.
Then there, yeah, so,
You're on the money.
yeah, there you go. Any other questions on the tax before I get to tax shelter stuff?
That means you real Zoom people as well, if you have any questions.
And for people on Zoom, don't hesitate. If you want to unmute your mic or if you want to type it in, Jeanette can read me the questions because I'm not looking at the Zoom screen.
Yeah.
Either.
Oh, go ahead. Nice and loud so everybody can hear, please.
Is, does money you put into RRP and RRSP get taxed on the way in or just on the way out?
On the way out.
Just on the way out.
That's on the next slide. Yeah. And don't even get me started on what happens to Lyra. And I don't mean the Italian money. You see, that's the beauty of the Canada Revenue Agency, is they've broken everything into initials. And what's really weird is once you start getting used to the initials as being part of your language, you forget these things mean something, and they mean nothing to people who don't speak your acrimonious language. Yes, Canada's acrimonious. That is the technical term. I don't know what it is in French, but I'm sure it's something. There are several different forms of tax sheltered income. The 2 most common are RSPs and TFSAs. An RRSP is a registered retirement savings plan. An RRP is a savings plan that is run by an employer. So it's just called a registered retirement plan. And it can be a fixed benefit plan or it can be a fixed income plan. It's still called an RRP. It has nothing to do with the way in which the money comes out. It's important to understand if you're going to build wealth, because remember, that's one of our goals, one of our objectives, is how do you best build wealth? If you want to build wealth. If you're not going to keep any money, then you're not going to build any wealth. It's kind of the way things work. But if your goal is to build wealth, it's what do you do with this money? You've paid off your debts. We talked about 50 shades of debt last time. You know, get rid of that high interest debt first. Although other people will say get rid of your lowest debt first because you feel good about paying it off. So there's kind of 2 schools of thought. I'm still a big fan of high interest debt first. That's just me. Economically, it makes the most sense. So we've controlled or we've reduced our debt. Now we're building wealth. What are we going to do with that money? Will you build up a bit of an emergency fund first? Once you've got your emergency fund, what do you want to do with that money? And some people will choose to put that money into tax sheltered types of these. Registered in educational savings plans, you can put money in, and in some circumstances, not all circumstances, the government will match 20% of that contribution, up to a maximum of 5,000. We just looked at it. $5,000, and so
25%.
are those? Oh, I thought it was 20 because we got 1,000 on that 5,000.
Oh, yeah.
Yeah. But there are income limitations to the ability of the government to match. So if you earn too much money, if your family income is over a certain threshold, you can put the money. The money grows tax-free, and when it comes out, the student can take it out for post-secondary education. If the student or the family, because you can designate the family, if they don't go to university, you can pull it out and you can actually put it into your RRSP. However, grandparents can also contribute. And if grandparent is over 70 years old, you may not contribute to your RRSP because you can't make contributions until in the year you turn 71. Your last shot is the year you turn 70. And using that information is really important for retirement planning, which is something I never thought about when I first started doing this in 2015. Now I think about it all the time. Yeah.
Funny that.
Well, it's interesting. It was like when we did the, remember when you did the estate planning workshop, which should have been 2 workshops, because I did a great thing on the legal part, a great thing on the financial part, and it was just so much information.
Too much.
Yeah, but it was great. I mean, don't get me wrong, it was great information. All the people in there were too old to be there. Their kids should have been there. And that's one thing I find with planning is, even if you can't do anything, you need to understand it before you even make a plan to do it. And the number 1 question I get is, why aren't you doing this in high schools? And the answer is because they won't invite me. I would be happy to go and speak to people at high school, because understanding the way the system works is really important, even if you're not going to start doing anything for ways down the road. But what a lot of people don't understand is that RSPs and TFSAs are not investments. And I like to use the example. I used to have lots of pens. We used to, back in the day, we had a budget for a lot of pens. And now we have a budget for 2 pens, and it really takes. No, it's okay. That's what they're here for. I used to have all these pens. I had different colored pens for different colored investments. I mean, that was how much fun we used to. This is the post-COVID Zoom world. But what I like to say to people, it's like a bottle of wine. It's like a basket of pens. You drop the pens in. The pens are the investment. This is the vessel. So your RSP and your TFSA, you can't say they're doing well or they're doing badly. All you can say is the stocks, the bonds, the whatever I've got inside the vessel is doing well. The vessel determines how it's treated from a tax point of view. And that's what people don't get. They think that the RSP is an investment, because financial advisors don't bother to tell them. They say, get an RSP. What they don't tell you is it's going to be with the investments that I'm selling you. And when the banks say, well, get your RSP with us, what you can do is you can get your own RSP. You can put your own stocks into it. It's called self-administered RSP, but I digress. Let's take a look at the differences between them, and then we'll answer some questions and we'll get on to some investment stuff. And we'll spend about half an hour doing investment stuff. We'll pick up on that in April. So here's what an RSP is. RSP, Registered Retirement Savings Plan, and it enables people to contribute for their own retirement. What happens with an RSP is you put the money in and it is deducted. So the higher your income, the better the advantage on your RSP. So RSPs can be a very good thing, and it's especially good if you've got a relatively high income. Second thing is it's limited to 18% of your income, but it is cumulative. And since most people don't put the maximum into their TFSA, or sorry, their RRSP, most people have room. And that can be very, very helpful if you ever have a big whacking chunk of money come in at one time. Remember selling an investment apartment, having a big capital gain. So to have the value of that, put it into an RSP to mitigate the tax liability, because you only get taxed on half when it's a capital gain. Unfortunately, my mother and father refused, my dad refused to do estate planning. My mother had to take the entire hit on the sale of a piece of real estate. And she didn't have the ability to use her RSPs because she was over 70 years old. And she had to take the whole hit herself because my dad had passed away. And so she, for 1 year, was in the top 10% of income earners and lost her old age pension for a year. Yeah. But I digress. If you have a company pension plan, it reduces your limit. And that's your RRP. So your total can't exceed 18% of income. but you can catch up, as I say, if you want to. Some companies, by the way, I don't know whether private sector companies do this, but I do know the public sector companies often do this. If you, let's say you worked part-time for a time, you can actually buy back pension. But that depends on the pension plan that you were in. And the only reason I know this is that my sister and brother-in-law were, they're retired now, are educators, and they were able to do that with their teacher pensions. You can borrow against your RSP to purchase a home, but you have to pay it back. You have 10 years to pay it back. So it can come out tax-free, and you have to pay that back. You don't get to deduct it again. That's in lieu of your other deductions, just so you know. And if you don't pay it back in 10 years, the amount not yet repaid is deemed to be income. And so you jolly well better pay it back, or it can cause real problems. So withdrawals are added to your income, and you can withdraw under a couple. Well, you can take your money out any time, but you're going to pay tax on it. And you can do that up until the year in which you turn 70. When you turn 71, you are a completely different tax person. Your life changes overnight. And what happens is you must do one of two things with that lump of money that you have in your RRSP. You can either turn it into a registered retirement income fund, but of course, we wouldn't call it that. It's called a RIF. So I love it. Some of the things you use, TFSA, RRSP, but with the RRA, it's a RIF. And you must convert it into a RIF, or your other alternative is you can take it as a life annuity. And you can take it in any, if you're married to common law for tax purposes, you can take it as a joint life annuity, or you can take it as a single life annuity, or any combination of those. If you're single, you have no choice. You take the money out, or you take out an annuity that will last until you die. And there are various annuity forms. And most people don't advise them, but they still sell them because it goes on and on. It's guaranteed until you pass away. You cannot deduct your losses for any of your fees. Remember I talked that little section, I said that secret section? Carrying charges. Carrying charges do not apply to RSPs or TFSAs for a very simple reason, is you're not paying tax on it. So you're paying carrying fees, such as interest, on things that are designed to generate taxable income. So effectively what it does is any of those fees come out what it's worth. When you take it out, you're not paying the tax because you already paid your advisor or your self-employed, self-administered person, or whomever, whichever you've chosen to do. You can get your RSPs through a financial institution, a brokerage firm, or you can do what's called a self-administered RSP, and you pay a fee, but you can put your own pens into the RSP bucket, as it were.
Is it worth drawing down on an RRSP before it converts to a RIF? Or I guess that depends.
I think it does. In
Yeah.
fact, that's my plan.
Oh,
So one of the things you can do, see, this is more retirement, and none of you are close to retirement, but there might be some people that are wanting this for their parents. You could be giving this information to your folks. So one of the things you can do is you can delay both your Canada pension. A lot of people don't know this. You can delay your old age security as well. A lot of people don't realize you can do both. If you delay your CPP, Canada pension, until you're 70 years old, it bumps up by 42%. With your old age pension, it bumps it by 36%, 6% per year. A lot of people are advising to get rid of to take your RSPs and delay your CPP and OAS. And the reason is twofold. Number one is you can draw it down because you're not getting that extra earnings that you can't do anything about with CPP and OAS. Remember, that increases your taxable income. But the other thing is, if you die prematurely with a lot of money in your RSP, that whole amount is considered to be taxable income at the highest tax rate. You're deemed to have taken it out. Now, if you're again, and I'll use the term married for tax purposes. Okay, so that can include common law married couples. You can pass that on, but you can't pass it to anybody else. So you can't name your children or your grandchildren. You can with your TFSA, but you can't with your RRSP. So you can't leave it to your kids so that, you know, they can't put it into their RRSP. It's taxable. And so you want to draw that down sooner rather than later. My plan is to draw most of mine between the ages of 60 and 70, or 65 and 70. And I talked to a tax guy and he was doing the check at Flood brokerage firm, offers this as a service. He goes, wow, yeah, you really do understand what you're doing. I said, yeah, I kind of did a little bit of research on it. But that's a route a lot of people are taking is the deferral. And the biggest reason people are taking the deferral is what you're getting longevity insurance and you're getting inflation protection, because both your Canada pension and your old age security are indexed pensions. And again, I'm not saying you should do that. Oh, by the way, if you're a woman in British Columbia, you are in the top life expectancy group in the country. Yeah, British Columbian women are not like women are actually Canadian women on the world chart do really well. But British Columbia, men and women, are the highest in Canada. And so we'd like to thank all of you smokers in Newfoundland and Labrador.
Yeah.
You know, I looked at the charts. That's where the lowest is yeah, but actually men in British Columbia do very well as well. But if you're a British Columbian woman, that's my advice to you, because, and if you're a British Columbian woman who lives in Whistler, you're still going to be skiing when you're 90, never mind life expectancy.
So an RRSP, there's no beneficiary, it goes to the estate.
No, RSP, you can have a beneficiary who's a spouse,
Oh, okay, sorry.
or it goes to the estate.
Oh,
It could only be left to a spouse and then it flows through
or no,
tax free.
yeah, okay.
If you don't have a beneficiary, if you do have a beneficiary, if they're not the spouse, that's income.
Can you take money out of these things at any age, or if you have to reach, so you take it at any age?
Any age, and you'll pay tax on it.
Yeah, and when does the tax rates, I'm assuming between 65 and 70, they start to get less?
No, all you get is you get an additional tax credit when you turn 65.
Oh,
Doesn't change your tax rate, it's a tax credit. And in fact, if you earn too much, they even take that away from you.
so,
Your tax rate doesn't change, you just get an additional tax credit. It's only worth a couple $100.
right, so why would people not put money into these things then?
Why would they not put, I'm sorry.
Yeah, why would you not put, if you can take the money back out at any age and the tax rate doesn't change, is the tax rate higher than?
But it could put you into a new tax bracket if you take too much out of one shot.
Wasn't the assumption you would take it out when you're earning a pension or a lower type of income?
Yes.
From what you would make
Right,
as a worker?
right,
And so then you're at a lower tax.
right.
Yeah.
That's the theory behind it.
So the lump sums are just taxed as income?
It would be taxed as income, but remember, if you took a giant lump sum out, let's say you took $20,000 out, that goes on to the top. So that could easily bump you into the next tax bracket.
Yeah.
So if you were making, say you had a $50,000 income, you're not in a bad tax bracket. You take $20,000 out of your RRSP because you're tired of paying gas prices, you want to use it for an electric car. You're paying that at the marginal tax rate of the 5137 and above. To the 28, was it 28.5 or something? It's only 8.2. So I didn't remember all the decimal.
It's very different to the Australian system.
Yes.
Very different.
Yeah, and it's completely different than the British system as well. The British system, you can save up the money, you write the money off, and you've got an allowance that's tax-free when you take it out. I don't know anything about Australian taxes, but I'm supposed to be finding out about Australia and New Zealand taxes. A friend of mine. Now, TFSA, greatest thing ever invented. I quit putting money into RSPs as soon as they invented the TFSA. By the way, if anybody is from the United States and wants the US equivalent, it's not identical, but it's like what is called a Roth IRA. IRA is investment, a retirement investment account. IRA. Income retirement account. Anyway, it's a Roth IRA. The difference between the two is you cannot take money out of your Roth IRA until you're 59 years old. In Canada, you can put your money into your TFSA. You can take your money out of your TFSA anytime you want. You can even replace the money you took out of your TFSA, but you may not do that until the next tax year. So if you're using your TFSA for retirement, the trick is to take the money out right at the end of the year. If you have any money with which to replace it, you can put in your new contribution, right now $6,000, and an additional chunk of money, because you can always top it up to if you've taken money out before. It is a great way for emergencies. But I read 25% of Canadians have a major financial emergency in their lifetime. And having to use your RRSP to do, as opposed to your TFSA, can cause, especially if it's something above and beyond that you're taking out on top of your earned income, that can have devastating tax implications. Whereas with your TFSA, it doesn't have any tax implications. So the limit for contributions is $6,000 per year. And if you've never contributed, you put the new number in, $81,500. Now, you will have to have been either a permanent resident or 18 years old in 2009. If not, Google it. If you don't want to Google it, send me an email. You tell me the year, I'll tell you what your maximum contribution is. I'll Google it. But you have to have been 18 years old. So you can start your TFSA the year you turn 18. Your money grows, whether it's capital gains, interest income, dividend income, return on capital, whatever it happens to be, it grows tax-free within the TFSA. And here's the beauty of it. When you take the money out of the TFSA, it doesn't even affect your any social, it's not supposed to affect social programs. So in theory, what you could do is if you wanted to not only get OAS, but get gain on top of that, you apply for your OAS and use your TFSA money before you draw your CPP. There are actually people that teach strategies on how you can get gain, which was originally supposed to help the poorest of seniors. And you can actually game the system. There's people doing videos on it. I was actually quite surprised at some of their techniques, because it's a great program. Don't get me wrong, I would never get rid of it, but it certainly wasn't designed to be used as kind of a tax dodge type of thing. That was never their intent, because when they put gain in, you didn't have the ability to defer your Canada pension. That wasn't in the cards. Oh, by the way, you can take your Canada pension early and you get less if you want to. And that does work for some people. You don't have the option. You cannot take your OAS until you're 65. But you don't have to. You can choose to defer. So when they first came out, I was told that the rules for TFSAs were the same as RSPs. They're not quite. If you have foreign stocks that generate income inside of your TFSA, you pay income tax on them to them. So I have a couple of small dividend payers that my broker put me into. And so I pay the US, but I do not get a matching Canadian tax credit. Usually what happens is if you make money in one country and pay tax in that country, if we have a tax agreement with that country, so Canada, the United States, Canada, the UK, Canada, Australia, it's balanced out. So when I have to, send that pittance of money to Mr. Biden, I get that back. You do not get that if it's in your TFSA. But if you make a capital gain from a US stock, they don't tax that. They do tax dividend income. If you have, say, shares in Microsoft, they pay a small dividend, and you pay 15% foreign withholding tax to the US government. You cannot, unlike non-registered funds, deduct losses or interest to borrow money to put into your TFSA. So you don't get a tax advantage from doing that. You can do it, but you can't write that off. If you have a non-registered investment, nothing's tax deductible. You can't write it off, you can't write it in, make money, you pay the tax on it. However, you pay the tax on the dividends, and if you, as you noticed in your notes, you've got those two lines for dividends. Qualifying dividends, which is most investments pay qualifying dividends. The reason that I don't take that column out is every once in a while I get people that are self-employed. And if you are self-employed and incorporated, the tax rate on corporate profits below $500,000 in the province of British Columbia is only 11%. When you take that money out as a dividend, you get a smaller tax credit. The tax credit is to acknowledge the fact that dividends come out of the company with after-tax dollars. And you pay as you go. So if you make a dividend, pay it right away. Make a dividend, pay it right away. Capital gain, on the other hand, if you buy a stock or you buy Bitcoin and it goes up, you don't pay any tax on that until you sell it. And the fancy term for that, you might want to write this down, it will be on the final. It's called realizing your capital gain. So capital gain that it went up is called an unrealized capital gain. And when you sell it and make the capital gain, that's called realizing your capital gain. Now you can impress your friends and family when you're hanging out with them, you know, because people are impressed by this kind of stuff. That was a joke. They won't be.
Not.
Yeah. If you have foreign stocks, if we have a reciprocity agreement, so pay your 15% to the IRS, you get a tax credit in Canada, so it balances out. And the beauty is if you borrow money to buy an investment, whether it's stocks, whether it's real estate, that is fully tax deductible against your personal income. So if you've got something and you borrowed it and you paid 5% on it, it pays a 5% dividend, you're actually better off, even though in theory you broke even. But because of the tax implications, you get a full write-off of the interest and a tax credit on dividend. So there are some real advantages to borrowing money in order to make investments. It's really interesting. People are reticent to borrow money to buy stocks, and yet nobody that's buying real estate as an investment has any problem whatsoever borrowing money for real estate. It's a really interesting psychology. Because if the if things go south, you can sell a stock in a heartbeat, and it takes time and money to sell a real estate investment. Any good questions on tax? I'm going to talk a little bit about investments just to get you warmed up for next time, making you want to come out or not come out, as the case will be.
I mean, they're still coming out. They're
And they
Logging on
can
to Zoom.
type in or talk. I'm
Yes,
happy.
my question for you, Bill, is so in terms of the list of things that Jeanette has learned from Money Matters, the TFSA thing is one of them.
Uh-huh.
And I remember how my heart was warmed by the idea, like there's a weird perception that like if you're a responsible grown-up, you have an RRSP. And so and I was not making very much money when I moved to Whistler. And so when you said it's actually better to have a TFSA if you're making less than a certain amount.
$60,000.
There you
I
go.
did the math myself.
But I feel like there was a second part to that, the criteria list, and maybe I'm misremembering. Is it, I feel like maybe you said, especially if your place of work
Yes.
contributes.
If there is, so the exception to my rule is, if there is a matching RSP, and now a lot of companies have gone with that as opposed to an RRP, and it's voluntary. If you contribute $100, they contribute $100. In an RRP, it's kind of, you don't have a choice,
Mhm.
and for the most part. absolutely take it. That's like saying no to free money.
Mhm.
And one of the things I have always said about free money is
Take
say
it.
yes,
Yeah.
you know? You know, it's like Billy's Law of giving money away. If you're gonna give money away, give it to Billy. But yeah, that's the exception to the rule. If you're in a company that's got a matching program, obviously take that. I would love to see some mechanism to have people have the option, even for an employer-related plan, to be able to use that money in a TFSA rather than an RRSP. But again, Krista Freeland doesn't call me on a regular basis and say, hey, Bill, let's chat.
Alas.
Yes, she's got a lot on her plate right now, so I guess I can. Like she can be forgiven.
So what was the first nugget of wisdom? There was a number you said you figured out.
About
right?
60K.
Which was-
About 60K a year. It's not worth putting money into, unless you've maxed your TFSA.
Okay, so up to 60K, do which one?
TFSA.
Below
Okay.
60K, do a TFSA.
Oh, that rhymes.
There.
And that's the point at which it breaks even, but I think that even if it's a pick-em between the two, your flexibility on a TFSA is such that it's worth having your money. Now, if you're planning to invest $10,000 a year, by all means, do the $6,000 in your TFSA, throw the rest in your RSP. That's great. But I believe it should be TFSA first, RSP second, if your income is above that bracket. Now, as soon as you get into that, I have to do this from the notes now. Once you get into that $86,000 a year range, that changes the dynamics all completely. Because understand, most Canadians are going to be with Canada pension, if you've contributed for most of your career. The maximum is 14. Very few people get the maximum. Apparently the average is around 7, and it's about 700 for your old age pension. If you're taking money out of your RSP, you could well qualify for paying, and you pay no tax on that. And you can build that money up over a lot of years. There's some really, really neat graphs. If I were to do this at a high school, I'd do it. They showed the difference between starting at 18 and quitting at 30, and starting at 30 and quitting at 65. And it's amazing how starting early and letting compound interest do the heavy lifting is absolutely the right decision to make.
So what's gain? That's for low income.
For low income seniors.
Mhm.
It irks me that people are using that as a tax deduction when it was never, ever intended to be that. It was intended for poor people, for poor seniors, that kind of thing. I'm going to quickly tell you that the 3 forms of investment, or 3 of the classic forms of investment financial instruments. Depending on if we get, I had one slide right at the very last that shows weird investments. I'm going to have to add, was it NTFs?
NFTs.
NFTs, yes. I'm sorry, that was the dyslexic version.
It's okay.
Non-fungible tokens. I mean, to me, this is a modern Ponzi scheme, but that's just my opinion. And there are people that will argue with me, and that's cool. But yeah, but collectibles is a very, very interesting form of investment. I don't recommend that to most people, by the way. The average person should probably not be in the art collection or Scotch collection business. You gotta know what you're doing. But that's another story for another day. So let's start at the bottom. The most basic investments are what we call fixed income or savings. So your savings account, your guaranteed investment certificates, government bonds, corporate bonds, and though I don't recommend them, the next level down is called junk bonds. The real term is high yield bonds. And they're high yield because there's a darn good chance you're never going to get your money. What you're doing is when you buy a bond, is you're lending money to somebody. So if you buy a BC Hydro bond, and BC Hydro issues bonds because they don't issue stocks, you're lending BC Hydro money. So when they built the Site C dam, they had a big issue of BC Hydro bonds. And that's one of the ways they finance that particular project. Other companies sell bonds. They're called corporate bonds. Governments are the big sellers of bonds, and that's how governments finance a lot of their activities. So the government of Canada issues bonds. They issue short-term bonds and long-term bonds. We call them bonds. They call them that in England, I think Australia too. In the US, they call them treasury bills. I love what the Germans call them. This is my favorite, is they call them gilts, because they feel guilty by the fact that they're having to issue bonds, but it's called a gilt in Germany. It is the most basic form of investment. It's probably the safest investment. Interestingly enough, you can make a capital gain on a bond, and it depends on interest rates. When interest rates go up, face value of the bond, or the market value of the bond drops. It's an inverse relationship. And so as interest rates go up, you're going to see bonds changing on a fairly regular basis. That's in your notes. Oh, by the way, I checked today, Government of Canada bonds as of today were not at 1.93. That was what Mr. Google told me when I was in the library. They were at 2.23. So when the Government of Canada goes out to the market to borrow money, they auction off these bonds, and the interest rate that the market is paying is 2. This is ridiculously low. This is lower than an American T-bill for 10 years. Canada is one of the highest rated countries from a financial perspective in the world. And so people have confidence in the ability to get paid back. They have confidence in the economy of Canada. They've got confidence in the governance in Canada. And so the bonds are, the Government of Canada can borrow fairly inexpensive. And that goes up and down with the market. It has gone up a lot. It was down as low during COVID when everything had dropped. It was down to like 1.47%. It was a great time for governments to borrow money. By the way, back when I was a youngster, in the olden days, they had these things called Canada Savings Bonds. They don't have those anymore. But I used to always get Canada Savings Bonds through my, I did that, yeah. And I did that because my parents did that. And my parents actually used that to save for Christmas. That's how they paid for Christmas gifts. Stocks represent you owning a piece of the company. And you get a share of said company, hence they call them shares. And the value of the stock goes up and down and all around, depending upon how much confidence people have in the stock. Some stocks are based on their earnings, and that's a mature company. So your bank stocks, Canadian bank stocks, my favorite kind of stocks, because I'm boring when it comes to investing. My dad, on the other hand, he was one of these guys that would buy mining shares. I used to tell him I had the old man portfolio, and he didn't. They go up and down. Some stocks pay dividends, some do not. So your more mature companies will often pay a dividend. And a lot of people, especially as you get older, you'll buy stocks that specifically pay dividends because you want quarterly or monthly income. Now, next time I'm going to show you some really great ways to get monthly income. Because I have to balance this now. You see, when we first did this, it was supposed to be money matters for millennials, and that's not who came. I remember one time, I bet half the people here were looking for retirement advice. It was not what we expected when we started. So some stocks have different classes of shares. They'll issue preferred shares. So for example, in banking, for the bank to lend out a certain amount of money, even though they borrowed that money to lend it out, they have to have ownership in a proportion. It's called the reserve ratio. And so what the banks need to do is they need to get more equity in. And one of the ways they do that is they issue a share called a preferred share. And it usually pays a dividend. It has a higher claim than the common shareholders. So you get dividend income, and it's very much like a bond. The difference is it used to be if they issued this thing, they give you that dividend forever. Now they reset that based on the prevailing interest rates. It's called a preferred. Preferred shares used to be a really, really good way
to do income investing. But when they changed to these resets, they became a lot less desirable as a retirement vehicle. But there are two classes of shares. And sometimes you'll see a share and it'll say like such and such A, such and such B. If it just says such and such with no letter, it's usually what we call a common stock. Now, with some of the tech stocks, they've got really goofy share structures, and I'm not about to go on and explain that because A, I don't completely understand. I understand it, but I don't have the expertise. And frankly, I mean, it's 20 after 8 at night. I'd even fall asleep and I'd still be talking. It's a talent, what can I say? So here's what the Royal Bank is the stock I use, my go-to stock. It's one of the most solid stocks in Canada. I mean, good heavens, our big 5 banks are older than the country. I think BMO is the oldest, but I'm not sure. So this is how much money you'd have been making, and you can see it's come up, and actually in 2020 did really well. The banks have come off a little bit of late. But they pay a nice dividend. They just raised their dividend. You know, in Canada, we like our bank stocks. We like our bank stocks. We like our TELUS, our utility stocks, Enbridges, those types of things. And then there are other stocks such as Shopify, which is a tech stock in Canada. It does not pay a dividend, but it's screened way up and then it's come crashing back down. So some of these upstart companies tend to have a great deal of variance. Here's some terms. There's the share price. That's how much the shares last traded at. The market cap is where you take the total number of shares and multiply it by the price of the share. So you can see, you know, with a stock like Tesla, that goes up and down like mad every time Elon makes a tweet. All of a sudden, the theoretical value of the company goes back. By the way, it isn't really worth close to that because only a few of those shares traded at a really, really high price. So when they quote the net worth of some of these people, they're worth a lot, don't get me wrong. Gates maybe, because his is all over the place. But when it's all in one, like a Bezos or Elon Musk, it's based on very few stocks. And it's what the last one sold at. Well, you couldn't sell all the shares that you own for that amount of money. But that's what we call the cap rate, or the capitalization rate. Annual return is how much it gained or lost in the last year. Profit per share is you take how much profit the company made and divide by the whole number of outstanding shares. That's your profit per share. That's a really good measure of a stock for the long run. Sometimes what they do is they are forced to do forecasts. And so you'll have the price earnings ratio. That's the price of the stock from the earnings of the stock. And then they'll say, in the future, we think it will be worth this. Because in the stock market, you're actually betting on the future more than you're betting on the present. And that's why stock markets tend to go down before recessions, and they actually tend to come up towards the end of recessions because people are confident things are going to get better. And it shocked everybody that when the markets crashed when COVID first started, they rebounded so quickly and went up amazingly in both, well, certainly they recovered by the end of 2020. 2021 was just an incredible year for the stock market. And then there's a thing called the beta, and that is a measure of the volatility. So you've got stocks and you've got bonds, and your variant on your stocks is your preferred choice. Now, next time I'm going to talk about things like exchange traded funds, which are bundles, mutual funds, which are really dumb investments. And I'll explain why. And then we're going to get into sort of some techniques and ways that you can look at this when you start, and you can start investing with a very small amount of money in today's world, especially with exchange traded funds. You can start investing with as little as $100. And what I say to people is it doesn't matter how much, it matters that you get started. Because if you want to succeed, it's all about developing habits. I've got 5 minutes. Are there any questions? Nobody's ever accused me of not covering enough information in any of my workshops. I have one workshop that I do in pricing. I do it in 3 hours, and there's 27 pages of notes. Single space.
Zoom people, you are welcome to chime in at this point.
We're using the term Zoom people.
And of course, Bill's email address is on the front page of the notes, so you can always email him
Yeah.
with very specific / esoteric / personal questions.
Not too personal.
Anybody in the room?
Questions, comments, pub time?
Might be. Oh,
Oh,
here's a question. Can a non-resident of Canada open a TFSA?
no,
No.
you must have your PR in the TFSA.
Okay. Gotcha. Did you hear that? You must have your PR. So you don't have to be a citizen, but you have to have your PR to open a
If
TFSA.
You get the permanent SIN when you get PR.
Yes, if your SIN starts with 9, then you cannot. If your SIN starts with, in British Columbia, 7, then you can. But it's not 7 in every province, it's 4 in Alberta. But 9 is, you're here on a working visa that's for non-permanent residents. But the cool kids call it a PR.
Anybody else?
What are the top 5 tax deductions that people overlook?
Deductions? I don't think they will do again. Because there's so few now. In terms of pure deductions, a lot of people don't realize that if you've got a safe deposit box that you keep anything valuable in, you can deduct that as an extra expense, but it's usually a pittance. It's the tax credits that people would generally not know. A lot of people don't know that, for example, student tax credits are transferable. I guess that's the one downside. Back when you had to go through the book and you were doing these things manually, you'd actually have the book in front of you. It would give you these little tips. But I guess when you're doing it online, unless you press the little information button. So that's probably one that would go by the wayside most frequently. Most investors that borrow to invest know that interest is deductible. So I don't think that goes by the wayside very often.
Can you deduct your bank fees as cost of managing your financial affairs?
Theoretically, if it was in a savings account, yes. If it was just a checking account, no. You could probably, if that got audited and they were really picky, they would probably not allow the bank fees on your checking account because it has no possible way of earning taxable income. Therefore, it shouldn't be allowed. But if you had a service fee on your savings account, it is generating taxable income, that would be a carrying charge.
I won't get more specific. I claim my what you would call checkings account back home because I have to have that account to get a fee-free savings account. So therefore, that is the cost of having my bank set up.
And you know what? An auditor would probably accept that because you couldn't get one without the other. Therefore, in order to get something that can generate income, I had to pay, and they'd look at it as a bundled product. You know, and so for the $120 a year you're writing off, I'm sure that the Canada Revenue Agency is not going to send you to tax prison. That would be the argument that I think one would use. And the chances of that ever going to tax court are pretty small.
Makes me feel better about my bank fees.
Okay. Okay.
Anybody else? Real or imaginary?
I know a lot of things people take that they're not allowed to take, but that's a completely different matter.
I have to say, having done, well, I was on TurboTax like 2 days ago. It does ask you which credits you want to claim, but you're right. You really have to drill down
To know what that
to know what
credit
it
is.
means.
Yeah.
So yeah, that's interesting.
Yeah, but it's easy to do that. You click the hyperlink and
Yeah.
it'll tell you what that is.
Yes, yeah.
But they're asking that all the time.
Oh, thanks for the session. Thank you for being here. Yes, and I almost forgot that Brad took a couple of courses last year. And so he was a student. He was enrolled in a university last year. Oh, like completely would have forgotten if he hadn't given me his paperwork in a
And
timely
again,
fashion.
I think even if you're a part-time student, you can deduct, you can get a tax credit on the tuition, but I also think you can get a tax credit of $50 instead of $200, depending upon the circumstance. What's beautiful is the educational institution that issues it, it has both of those, the tuition amount and the monthly amount. So they know what the rules are, it'll be right on the slip. And I'm sorry, I don't remember the T-slip number for that. I haven't looked at one of those in a long time. I haven't done people's, I used to do a lot of people's taxes. I haven't done that for years.
Anybody else? 8:29.
No.
Make sure you phrase your question before you answer.
Yeah.
All right.
Okay, on behalf of the Whistler Public Library and myself, thank you very much for coming out. I hope to see you again in whatever number it is, 19th-ish of April. It's when I get back.
I think it's the 20th.
Is it 20th? I think you may be right. Yeah, it's after it's after
Yeah.
Blackcomb closes.
Yes, Wednesday, April 20th will be session 3, which is more.
More
Investment.
investments. More and more investments.
Mhm.
Okay.
All right, thanks, everybody. Zoom, we're gonna say so long.
We're
To you
gonna
folks.
Zoom now.
Gotta Zoom. Oh boy. Okay, thanks for being here. And let me know if you have any questions via email. Good night.